Before we begin, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The information presented here is based on research and experience, but it should not be considered as a substitute for professional financial or legal advice. Auto insurance rates, regulations, and policies vary significantly by state and by individual circumstances. Always consult with a qualified and licensed professional before making any financial decisions. You just spent 45 minutes of your life you will never get back. You meticulously typed in your name, your address, your date of birth, your driver's license number, and the VIN of your car, which you had to go out in the rain to get. You answered 100 different questions. Do you own or rent? What's your job title? How many miles do you drive to work? Is your car equipped with an anti-theft device? You clicked next, next, next. And finally, after jumping through all those digital hoops, you saw it. A beautiful number. A car insurance quote that's $80 a month cheaper than what you're paying now. You feel a rush of victory. You did it. You beat the system. You're about to save nearly $1,000 a year. So you click the big, bright green button that says, "Get my rate." And what happens next? Your phone starts vibrating off the table. Ding. An email from an insurance company you've never heard of. Ring. A call from a local agent named Brenda. Ding. Another email, this one promising even lower rates. Suddenly, you're not a customer. You're a target. You're fresh meat thrown into a shark tank of hungry sales agents. And that beautiful number, that $80 a month savings, it vanishes. The real quote, after you talk to Brenda, is actually $10 more than what you're currently paying. You've been had. You've been used. Your personal information was the price of admission to a bait-and-switch carnival, and you didn't even get a prize. If this story sounds painfully familiar, it's because you are not alone. This isn't a bug in the system. It's the system itself. A recent industry analysis revealed that nearly 60% of initial online auto insurance quotes are what's known as teaser rates. They are intentionally lowballed estimates designed for one purpose and one purpose only: to capture your contact information so it can be sold to a network of desperate agents. You weren't getting a quote, you were filling out a lead form. You were selling yourself for free. And because of this broken, misleading process, the average American driver overpays for their car insurance by an estimated $400 a year. That's billions of dollars in collective overpayments, siphoned from our bank accounts, all because the process of getting a simple, honest answer is deliberately confusing. But what if I told you there's a way to cut through all of that noise? A way to become completely invisible to these data hunters and get a rock-solid, accurate quote online, without ever having to speak to a soul until you're ready to buy? What if you could hold in your hand a number that an insurance company is actually bound to honor? That's not a fantasy. It's a strategy. And over the next 10 parts of this series, I am going to give you the exact blueprint to do it. By the time you finish this presentation, you will be in the top 1% of informed consumers. You will understand the fundamental difference between a lead generation website and a true direct-to-carrier quoting engine. You will have a checklist of the exact documents and information you need before you even open your web browser, creating what I call your quote kit. You'll learn how to spot the red flags of a bait-and-switch site in under 10 seconds. I will show you which specific questions on those long forms are actually designed to trip you up, and how to answer them correctly to unlock hidden discounts you're probably entitled to but don't know about. We will demystify the jargon: liability, collision, comprehensive, uninsured motorist, personal injury protection. These won't be confusing terms anymore. They will be tools in your toolbox that you can adjust with confidence to build a perfect policy for your life, not the one that makes an agent the highest commission. The goal here isn't just to save you a couple of bucks. It's to give you back control. The feeling of dread and uncertainty you get when shopping for insurance is a manufactured feeling. It is designed to make you feel overwhelmed, so you'll just give up and accept the first half-decent offer that comes your way. We are going to put an end to that today. We are going to replace that anxiety with absolute clarity and confidence. So, how are we going to do this? First, we need to understand our enemy. The online insurance world is basically the Wild West, and it's populated by three main characters. First, you have the data cowboys. These are the lead generation sites. They look like comparison websites, often with logos of all the big insurance companies plastered on their homepage. They promise to get you quotes from 10 different carriers in 2 minutes. But they don't generate any quotes at all. They are digital middlemen. Their only job is to get your name, number, and email, package it up, and sell it to the highest bidder. They are the reason your phone explodes the second you hit submit. They are to be avoided at all costs, and I'll show you exactly how to identify them. Second, you have the Lone Rangers. These are the direct carriers. Think of the big names you see on TV all the time. Going directly to their website is a much safer bet. You're dealing with the insurance company itself, so the quote you get is far more likely to be real. But this approach has a major flaw. It's incredibly time-consuming. To truly compare the market, you'd have to go to 10 different websites and fill out 10 different, painfully long applications. You're getting accuracy, but at the cost of efficiency. You might save money, but you'll lose your entire Saturday doing it. And third, you have the town sheriffs. These are the legitimate, licensed, independent online marketplaces and brokers. They are the hidden gems of the internet. These platforms have direct connections to the insurance company's real-time pricing systems. They can give you multiple, accurate, bindable quotes from different carriers, all in one place, often without you having to surrender your phone number until you've chosen a policy. They have a legal and ethical obligation to provide you with real numbers. Finding these sheriffs in a town full of cowboys is the master key to this entire process. And in a later part, I will walk you through step by step how to find and use these powerful tools. Before we get to that, however, we need to prepare. You would never go into a negotiation without knowing your numbers, and shopping for insurance is a negotiation. It's a negotiation between you and a multi-billion-dollar industry that has spent decades perfecting the art of pricing risk. Your risk is determined by your data. Therefore, the person with the most accurate and complete data wins. The insurance company has reams of data on you that you don't even know about. They pull your credit history, your claims history, your driving record, and sometimes even data from social media to build a profile of you. They know you better than you know yourself. To level the playing field, you need to arm yourself with your own data. You need to have everything prepared, accurate, and ready to deploy. This is your quote kit. It's a simple collection of documents and information that will turn a 45-minute guessing game into a 5-minute surgical strike. And in the very next part, we are going to start building that kit. I'm going to reveal the single most important document in this entire process. A piece of paper you almost certainly have filed away in a drawer or in your email. This one document contains about 70% of the information you need, and it holds the secret to ensuring the quote you get today is the price you actually pay tomorrow. It's your current policy's declarations page, and understanding how to read it is your first step to becoming an untouchable, expert insurance shopper. So let's get started. This page, this deceptively boring-looking piece of paper, is the Rosetta Stone of your auto insurance. It translates the confusing language of policies and premiums into simple, cold, hard facts. It is the single most important tool you have for getting an accurate quote, because it contains every piece of information an insurance company already knows about you. Trying to shop for insurance without it is like trying to build a house without a blueprint. You might get the walls up, but I guarantee the roof is going to leak. So, pull out your current policy. You can usually download it from your insurer's website or app. Find the page that says Declarations. It might be called a deck page for short. This is your treasure map. Let's start at the top. You'll see the easy stuff: your name, your address, the policy number, and the policy period. That policy period is more important than you think. It shows the exact dates your coverage is active. When you get a new quote, you'll be asked when you want the new policy to start. The correct answer is always the day your old policy ends. Not the day before, not the day after. An exact match. Why? Because any gap in coverage, even for a single day, can flag you as a higher risk and jack up your rates for years. A continuous insurance history is gold. This date ensures you get the discount you deserve. Next, you'll see your vehicles listed. A 2022 Ford F-150, a 2020 Toyota Camry. But look closer. You'll see a 17-digit number next to each one. That's the vehicle identification number, the VIN. This is the car's fingerprint. It's absolutely unique. And it's the #1 place people mess up when getting a quote online. You might think you're just selecting Honda Civic, but the VIN tells the insurance company if it's the base model LX with a standard engine, or the high-performance C with a turbocharger and a higher theft rate. It tells them the specific safety features your car was built with, like anti-lock brakes or side curtain airbags. One wrong digit, one wrong submodel, and your quote can be off by hundreds of dollars. The VIN doesn't lie. Your declarations page has the correct one. Use it every single time. Below the vehicles, you'll find the listed drivers. This is you, your spouse, maybe your teenage son who's just started driving. This section tells the insurance company who is regularly operating your vehicles. It's a list of the people they have rated for your policy, meaning they've pulled their driving records and calculated the risk they add. This is critical. If you have a licensed driver living in your household who you don't list on your quote, the insurance company will find them. They have databases for this. It's called an undisclosed driver. And when they discover them after you've already bought the policy, your premium will skyrocket. Or worse, if that person gets into an accident, your claim could be denied entirely, leaving you on the hook for everything. Having your deck page in front of you ensures you list everyone you're supposed to accurately from the start. Now we get to the heart of it all. The coverages. This is the section that looks like a bunch of confusing names and numbers. But this is what you are actually buying. This is the protection. Let's break it down, and I promise you will understand this better than 99% of people on the road. First, you'll see liability. This is probably the most important coverage you have, and it's the one most people don't understand. Liability coverage is not for you. It's for everyone else. It pays for the damage you cause to other people and their property if an accident is your fault. You'll see it written as 3 numbers, something like 50/100/50. This isn't a secret code. It's simple. The first number is the maximum amount in thousands your policy will pay for a single person's medical bills you injure. In this case, $50,000. The second number is the maximum total your policy will pay for all medical bills in a single accident. Here, $100,000. The third number is the maximum it will pay for property damage. That's the other person's car, their mailbox, a storefront, whatever you hit. Here, $50,000. Now listen to me. The state minimum liability limits are a financial trap. They are dangerously low. A modern car can easily cost more than $25,000 to repair or replace. A single night in the hospital can cost more than that. If you cause an accident and the damages exceed your liability limits, the other party can and will come after you personally for the difference. They can garnish your wages. They can put a lien on your house. They can seize your assets. All because you tried to save a few dollars a month by choosing the bare minimum coverage. Your declarations page shows you exactly how exposed you are right now. When you shop for a new quote, you need to know these numbers so you can choose to match them or, far more wisely, increase them. Next on the list is probably uninsured or underinsured motorist coverage, often called UM/UIM. Think of this as liability coverage that protects you from the other guy. What happens if someone without insurance, or with those dangerously low state minimum limits, plows into you and puts you in the hospital? Their insurance won't be enough to cover your medical bills or your lost wages. So who pays? You do. Unless you have uninsured motorist coverage. This coverage steps in and acts like the at-fault driver's insurance, paying for your injuries and damages. With 1 in 8 drivers in America being completely uninsured, this isn't a luxury. It's a necessity. Your deck page shows if you have it and how much. Then you'll see medical payments or personal injury protection, often called MedPay or PIP. This is simpler. It pays for your medical expenses and your passenger's expenses after an accident, regardless of who was at fault. It's designed to get you immediate medical care without waiting for insurance companies to fight over who's to blame. PIP is generally more comprehensive and is required in no-fault states, often covering lost wages as well. MedPay is more straightforward and available in other states. Your deck page tells you which one you have in the limit. Finally, we get to the coverages for your own car. This is what most people think of as full coverage. It's actually 2 separate things, collision and comprehensive. Collision is exactly what it sounds like. It pays to repair or replace your car if you collide with another object, whether it's another car, a pole, or a guardrail. It pays out whether it was your fault or not. Comprehensive is for almost everything else. Think of it as the acts of God or bad luck coverage. A tree falls on your car. Hail turns your hood into a golf ball. A deer runs out in front of you. Your car is stolen. Someone vandalizes it. That's all comprehensive. Next to both collision and comprehensive, you'll see a dollar amount. $500. $1,000. That's your deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. If you have a $500 deductible and a $3,000 repair bill, you pay the first $500, and the insurance company pays the remaining $2,500. A higher deductible means a lower premium, because you're taking on more of the initial risk yourself. Your deck page shows the exact deductibles you have right now. When you're getting a quote, you need to input these exact same numbers to get a true apples-to-apples comparison. Last but not least, scroll to the bottom of your declarations page. You'll find a list of all the discounts you're currently receiving. Multi-policy discount, good driver discount, paperless billing, paid in full, good student. This is your discount checklist. You are already qualified for these. When you get a new quote, you need to make sure you are telling the new company about every single one of these to ensure you're getting the lowest possible price. Don't leave money on the table. So there it is. Your policy's DNA decoded. The policy period, the vehicles, the drivers, the exact liability limits, the coverages for your own car, the deductibles, and the discounts. Every single box you need to check, every question you need to answer on an online quote form, is right here on this one piece of paper. You no longer have to guess. You can now input your information with the precision of a surgeon, guaranteeing that the price you see online is the price you will actually get. You've just dissected your current policy. You have the exact blueprint. But this blueprint was probably drawn up by someone else, maybe an agent, maybe you clicking boxes years ago. The real question is it the right blueprint for your life today? Because choosing the wrong coverage levels can be just as financially devastating as getting an inaccurate quote. And in the next part, we're going to build your perfect bulletproof coverage plan from the ground up, ensuring you're protected for the life you actually live, not the one you had 5 years ago. Let's start with the hard truth. The auto insurance policy you bought 5 years ago, or even 1 year ago, is probably dangerously wrong for the life you live today. It's a snapshot of a past you. Maybe you had less to lose back then. Maybe you drove an older car. Maybe you hadn't started a family yet. Using that old coverage as a blueprint for a new quote is like using a flip phone map to navigate a modern city. You're going to get lost and you're going to get hurt. So we're going to tear it all down and build from scratch. We're constructing your personal insurance fortress, brick by brick. And the foundation of this fortress, the absolute bare minimum required by law, is liability coverage. Think of liability as the I'm sorry fund. It doesn't cover you. It doesn't cover your car. It covers the damage you do to other people and their property. When you see numbers like 25/50/25, which is a common state minimum, that's what it's talking about. It's a code. The first number, 25, means your insurance will pay up to $25,000 for a single person's injuries in an accident you cause. The second number, 50, is the maximum total your policy will pay for all injuries in that one accident, no matter how many people are hurt. And that last number, 25, is the maximum it will pay for all property damage. That means the other person's car, the mailbox you hit, the storefront you scraped. Now let's put that into perspective. $25,000 for a hospital visit. Does that sound like enough? A single night in the ER, an MRI, a few stitches. You can burn through that before the paperwork is even filed. What about $50,000 for multiple people? Imagine a fender bender in traffic that involves 3 cars. That 50 grand gets split between everyone you injured. It evaporates. And the property damage? $25,000. The average price of a new car in the United States is now over $48,000. You rear-end a brand new Ford Explorer, a totally average family SUV, and your state minimum coverage might not even pay for half of it. So what happens to the rest? The $10,000, $50,000, $100,000 that your insurance doesn't cover? Comes for you. It comes for your savings account. It comes for your paycheck through wage garnishment. It can even come for your house. Choosing state minimum coverage isn't saving money. It's sitting on a financial time bomb and just hoping it doesn't go off. It is the single biggest mistake people make when getting a quote. They see the cheapest option and they click it, without realizing they are betting their entire financial future on never making a mistake on the road. So the first brick in our fortress isn't the state minimum. It's raising those liability limits to a level that actually protects you. For the vast majority of people, a good starting point, a solid, respectable baseline, is 100/300/100. That's $100,000 for a single person's injuries, $300,000 total for all injuries, and $100,000 for property damage. Why these numbers? Because they provide a serious buffer. $100,000 can cover a significant medical claim. $300,000 can handle a multi-car accident. And $100,000 in property damage means you can total a brand new Lexus or a Tesla and not have to drain your retirement account to pay for it. The surprising part is that jumping from a flimsy 25/50/25 policy to a robust 100/300/100 plan often costs just a few dollars more per month. It is the single highest value upgrade you can make to your policy. It's the difference between a cardboard shield and a steel one. Okay, foundation is laid. The walls are strong. We've protected ourselves from bankrupting someone else. Now we need to protect our own stuff. This is where collision and comprehensive coverage come in. They are often talked about together, but they are two totally different shields that protect your car. Collision is exactly what it sounds like. It pays to repair or replace your car if you collide with something. Another car, a guardrail, a tree, a telephone pole. It even covers you if you flip your car. If you are at fault, this is the coverage that fixes your vehicle. Without it, you're on your own. Comprehensive is for almost everything else. It's the act of God or weird stuff happens coverage. A tree branch falls on your car during a windstorm. A hailstorm makes your hood look like a golf ball. A deer decides to sprint across the highway at the worst possible moment. Your car is stolen. Someone vandalizes it. All of that is comprehensive. With both collision and comprehensive, you have to choose a deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. It's typically $500, $1,000, or even $2,000. This is a critical choice. A higher deductible, like $1,000, means you're taking on more risk yourself, so the insurance company will give you a lower premium. A lower deductible, like $500, means your premium will be a bit higher. So how do you choose? Ask yourself one simple, honest question. If I had to pay for a repair tomorrow, how much cash could I come up with without it causing a major financial crisis? If writing a check for $1,000 would force you to miss a rent payment or rack up credit card debt, then you should probably opt for a lower $500 deductible. But if you have a healthy emergency fund, choosing a higher deductible is a fantastic way to save money on your premium every single month. Now we have our fortress, strong liability walls to protect our assets, and a solid roof of collision and comprehensive to protect our car. But there's a threat we haven't accounted for. A threat from the outside. What happens when someone hits you, and they're the one with that flimsy state minimum coverage? Or worse, what if they have no insurance at all? This is a terrifyingly common scenario. The Insurance Research Council estimates that 1 in 8 drivers on the road is uninsured. That's like playing Russian roulette every time you merge onto the freeway. If one of them hits you, their insurance, if it even exists, won't be enough to cover your medical bills or fix your car. So you're left holding the bag for their mistake. This is where you need uninsured and underinsured motorist coverage. So important, it should be mandatory. This coverage steps in and acts like the other driver's insurance when they don't have enough, or any at all. It protects you and your passengers. It pays for your medical bills, your lost wages if you can't work, your pain and suffering. The smart move here is to match your uninsured motorist limits to your own liability limits. If you decided you need 100/300 of liability coverage to protect your assets, doesn't it make sense to have the exact same amount of coverage to protect your own body? You are protecting yourself from other people's irresponsibility. Do not skip this coverage. Finally, we have the finishing touches. The smaller, optional coverages that add convenience and peace of mind. Things like rental reimbursement, which pays for a rental car while yours is in the shop after an accident. If you only have one car and you rely on it to get to work, this is a lifesaver. There's also roadside assistance for when you get a flat tire, run out of gas, or lock your keys in the car. Then there's medical payments or MedPay coverage. This is a smaller pot of money, usually $1,000 to $5,000, that pays for your initial medical bills right away, regardless of who is at fault. It's fast, easy, and helps cover copays and deductibles from your health insurance. So there it is, your bulletproof plan. Strong liability limits like 100/300/100 to protect your future. Collision and comprehensive with a deductible you can actually afford to protect your car. An uninsured motorist coverage that mirrors your liability limits to protect you from everyone else. This is the exact set of coverages that will give you true peace of mind. This is what you need to build your quote around. But building the perfect plan is only half the battle. The other half is getting the absolute best price for it. And to do that, you need to understand the secret number that insurers use to judge you. It's a number that has a massive impact on your final premium. Yet most people have never even heard of it. It's not your credit score, and it has nothing to do with your driving record. In the next part, we are going to pull back the curtain on this hidden insurance score, show you exactly how it's calculated, and give you the steps to improve it, potentially slashing hundreds of dollars off your yearly premium. Alright, let's dive right in. This hidden number we're talking about is officially called a credit-based insurance score, or a CBIS. Now hold on. Before you click away thinking, "This is just my credit score," I need you to understand something critical. It is not the same as your FICO score or the number you see on Credit Karma. It's a completely separate proprietary score, calculated by companies like FICO, LexisNexis, and TransUnion, but it's created specifically for the insurance industry. Think of it as your financial reputation, translated into a language of risk that insurance companies can understand. You're probably asking, what on earth does my credit card balance have to do with my ability to merge onto a highway? And that is a fair, logical question. The insurance industry's answer is based on decades of data and statistical analysis. Actuarial studies, conducted over and over again, have shown a strong correlation between how a person manages their financial responsibilities and how likely they are to file an insurance claim. The logic from their perspective is that a person who is diligent, responsible, and forward-thinking with their finances tends to exhibit those same traits in other areas of their life, including behind the wheel. They're more likely to perform regular car maintenance, more likely to drive cautiously, and less likely to engage in risky behaviors. Now, is this system perfect? Is it even fair? Absolutely not, and we'll get to that. In fact, its use is so controversial that several states, including California, Hawaii, and Massachusetts, have banned or severely restricted insurers from using credit information to set rates. But for the vast majority of the country, this score is a silent, powerful force shaping your premium. It can be a bigger factor than your age, your gender, and in some cases even your driving record. Two neighbors with identical cars and identical driving histories could be paying wildly different rates, simply because of this hidden number. One could be paying $700 a year, the other $1,700. That's the power we're talking about. So, how is this secret score calculated? It pulls information directly from your credit report, but it weighs that information differently than a lender would. While the exact formulas are a trade secret, they generally focus on 5 key categories, very similar to a standard FICO score. The first, and by far the most important, is your payment history. This accounts for roughly 40% of your score. It's the simplest factor. Do you pay your bills on time? Every late payment, every account sent to collections, every bankruptcy or judgment acts as a major red flag. To an insurer, a history of late payments suggests a lack of financial stability or foresight, which they correlate with a higher likelihood of future claims. The second category is outstanding debt, often called credit utilization. This makes up about 30% of your score. This isn't about how much debt you have in total, but rather how much of your available credit you're currently using. Imagine you have 2 credit cards, each with a $10,000 limit, for a total of $20,000 in available credit. If you have a combined balance of $2,000, your utilization is a healthy 10%. But if you have a combined balance of $18,000, your utilization is a sky-high 90%. High utilization signals to the insurer that you might be under financial stress, which their data suggests correlates with a higher risk of filing a claim. The third factor is length of credit history, which is about 15% of your score. This looks at the age of your oldest account, your newest account, and the average age of all your accounts combined. A longer credit history provides more data for the insurer to analyze. It demonstrates stability and a proven track record of managing credit over time. Someone who has successfully managed credit accounts for 20 years is seen as a more predictable, and therefore lower, risk than someone who just got their first credit card 6 months ago. Fourth is the pursuit of new credit, weighing in at around 10%. This is where recent hard inquiries come into play. Every time you apply for a new loan, a new credit card, or a new mortgage, a hard inquiry is placed on your credit report. Opening several new accounts in a short period can be a red flag. From the insurer's perspective, it could indicate sudden financial distress, making you a less stable and more risky client. And finally, the fifth category is your credit mix, also about 10% of the score. This simply looks at the different types of credit you have. Do you have a mix of revolving credit, like credit cards, and installment loans like a mortgage or a car loan? A healthy mix shows that you can responsibly manage different kinds of debt, which paints a picture of a more well-rounded, financially savvy individual. So now you know the what and the why. You understand the 5 pillars that hold this score up. The next and most important question is, what can you do about it? How do you grab the wheel and steer this number in the right direction? This is where you can take back control. First, you need to know where you stand. You are legally entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, once every year. The official government-mandated site for this is annualcreditreport.com. Don't go to other sites that promise free scores but require a credit card. This is the official one. Get all 3 reports. Second, scrutinize them with a fine-tooth comb. Look for errors. A simple clerical mistake like a payment reported as late when it was on time, or an account that doesn't even belong to you, could be torpedoing your score. If you find an error, dispute it immediately with the credit bureau. They are legally obligated to investigate. Correcting a single significant error can cause your score to jump dramatically and your insurance premium to fall. Third, and this is the heavyweight champion of improving your score, pay every single bill on time. Every time. No exceptions. This is the single most influential habit you can build. Since payment history is 40% of your score, this is your #1 priority. Set up automatic payments for everything you can: your credit cards, your utility bills, your student loans. Even a single 30-day late payment can stay on your report for 7 years and significantly damage your score. Fourth, attack your credit utilization. Your goal should be to keep your total credit utilization below 30%. If your available credit is $10,000, you want your balance to be under $3,000. If it's higher, focus on paying down those balances as aggressively as you can. Another strategy is to ask for a credit limit increase on your existing cards. If your limit goes up and your balance stays the same, your utilization percentage goes down instantly. Just be careful not to use that new, higher limit as an excuse to spend more. Fifth, be strategic with old accounts. A common mistake people make is closing an old credit card once they've paid it off. This can actually hurt you in 2 ways. It reduces your total available credit, which can increase your utilization ratio. And more importantly, it can shorten the average age of your credit history, which is a key factor in your score. Unless the card has a ridiculously high annual fee, it's often better to keep it open, use it for a small recurring purchase once or twice a year, and pay it off immediately. And finally, be mindful when applying for new credit. Don't apply for 5 different credit cards in a single month just to get the sign-up bonuses. Each application creates a hard inquiry. While the impact of a single inquiry is small and temporary, a flurry of them can make you look desperate for credit. Space out your applications and only apply for credit that you actually need. Improving your credit-based insurance score isn't a magic trick. It's not an overnight fix. It's a process that requires diligence and discipline, but the payoff is enormous. We're not just talking about saving $50 on your next 6-month policy. We're talking about fundamentally restructuring one of the key data points that dictates your rates for years, even decades to come. By taking these steps, you are not just cleaning up your finances. You are actively lowering the risk profile you present to the entire insurance industry, forcing them to see you as the safe, responsible driver you are, and to price your policy accordingly. And the way you prove you're that safe, responsible driver, the way you translate your real-world identity into the digital language of an online quoting engine, is by having your information perfectly organized and ready to deploy. This isn't just about filling out forms. This is about building your personal insurance dossier. It's the single most important step before you even think about visiting a single insurance website. Rushing this part, guessing at the details, is like trying to build a house on a foundation of sand. The entire structure will be flawed, and the price you're quoted will be a fantasy. So let's build your dossier right now. Think of this as your pre-flight checklist. We're going to gather every single piece of data an insurer could possibly ask for, so when you start the quoting process, you move with speed, precision, and absolute confidence. We'll break this down into 4 critical categories: personal, vehicle, driver, and current policy information. First up, the easy part, your personal information. This seems obvious, but you'd be surprised how small errors here can cause big problems later. You'll need your full legal name, exactly as it appears on your driver's license. No nicknames. You'll need your date of birth. This is a primary rating factor. Insurers have mountains of data correlating age with risk. And you'll need your home address. This is non-negotiable and incredibly important. Insurance is priced down to the zip code, and sometimes even the specific street. They are analyzing traffic patterns, theft rates, weather events, and claims history in your specific neighborhood. If you live on the border of 2 zip codes, one could be dramatically cheaper than the other. Using a P.O. box or a different address to try and game the system is considered insurance fraud, and it will get your policy canceled and could even lead to legal trouble. Be honest and be precise. Next, and this is where most people get lazy and lose accuracy, is the vehicle information. Do not, under any circumstances, just guess at this. You need to know the exact year, make, and model. But that's just the start. The most powerful tool in your arsenal is the VIN, the Vehicle Identification Number. This 17-digit code is your car's unique fingerprint. It's the holy grail of an accurate quote. Why? Because a 2023 Ford F-150 isn't just one truck. It's an XL, an XLT, a Lariat, a King Ranch, a Platinum, a Raptor. Each of these has a different price tag, different engine, different safety features, and therefore a different insurance risk profile. The VIN tells the insurance company everything. It decodes the exact trim level, the engine size, the type of transmission, the factory-installed safety features like anti-lock brakes, airbags, and even advanced driver assistance systems like lane departure warnings or automatic emergency braking. All of these are potential discounts. You can find the VIN in a few places. On a small metal plate on the driver's side of the dashboard, visible through the windshield. On a sticker inside the driver's side door jamb. On your vehicle's registration, and on your current insurance card. Take a picture of it with your phone right now. Have it ready. When a quoting website asks for your VIN, use it. It is the single fastest way to leap from a vague estimate to a truly accurate quote. Beyond the VIN, you need to know your car's mileage. Don't guess. Go out to your car and look at the odometer. Some insurers will ask for the exact number, while others will ask for an estimate of your annual mileage. To calculate this, think about your daily commute. How many miles is it round trip? Multiply that by the number of days you work a week, then by the number of weeks you work a year. Then, add a buffer for weekend driving, errands, and road trips. A common estimate is between 10,000 and 12,000 miles per year for the average American driver. But your reality could be very different. Being accurate here is key. If you say you drive 5,000 miles a year but you're actually driving 25,000, you're not just getting an inaccurate quote, you're misrepresenting your risk. If you have to file a claim, the insurer might investigate that discrepancy, which could cause major problems. You'll also need to know the primary use of the vehicle. Is it for commuting to work or school? Is it just for pleasure driving on the weekends? Or is it used for business like making deliveries or visiting clients? Business use often carries a higher premium because it typically means more time on the road, often in unfamiliar areas during peak traffic hours. Finally, you'll need to know if the car is owned, financed, or leased. If you have a loan or a lease, your lender is the legal owner of the vehicle until it's paid off. They have a financial interest in protecting their asset, and they will almost always require you to carry both collision and comprehensive coverage, which we'll break down in detail later. Knowing this upfront prevents you from getting a cheap, liability-only quote that doesn't actually meet the requirements of your loan or lease agreement. The third category in our dossier is driver information. This is for every single licensed driver in your household who might reasonably drive your car. This includes your spouse, your partner, and any licensed children living at home, even if they have their own car. Insurers operate on the principle of permissive use, meaning your policy typically covers anyone you give permission to drive your car. But they want to know about the people who have regular access. For each driver, you will need their full legal name, date of birth, and their driver's license number. That license number is how they pull each person's motor vehicle record, or MVR, to verify their driving history. You need to be prepared to answer questions about each driver's history for the past 3 to 5 years. Have they had any accidents regardless of who was at fault? Have they had any tickets or moving violations like speeding, running a red light, or a DUI? Be honest. They are going to find out anyway when they pull the MVR. Hiding a speeding ticket will only result in your initial quote being wrong. When they run your official record, the price will jump up and you'll have wasted your time. You'll also be asked about each driver's occupation and highest level of education. This might feel intrusive, but it's purely statistical. Decades of data have shown insurers that certain professions and education levels correlate with lower claim frequencies. An engineer or a teacher, for instance, might get a slightly better rate than other professions. It's all part of their complex risk algorithm. Finally, we arrive at the fourth and arguably most overlooked category: your current insurance information. Go and find your current policy's declarations page. This is the summary of your coverage, usually the first or second page of your policy documents. If you can't find a paper copy, you can almost always download it from your current insurer's website or app. This document is a goldmine. First, it tells you exactly what coverage levels you have right now. This is essential for making a true apples-to-apples comparison. You can't compare a quote for minimum state liability with your current policy that has high limits, collision, and comprehensive. You need to quote the same coverages to see if you're actually getting a better deal. We'll dive deep into what all those coverages mean in the next part, but for now, just have that page handy. Second, and this is a huge one, your declarations page proves you have had continuous insurance coverage. A lapse in coverage, even for a single day, is a massive red flag to insurers. It suggests financial instability or a disregard for responsibility, and it will cause your rates to skyrocket. Some companies won't even insure you if you've had a recent lapse. Having your current policy information ready proves you're a responsible customer who has maintained coverage, and you will be rewarded for it with better rates. It will also list your policy start date, so you can accurately answer the question, how long have you been with your current carrier? Loyalty, even to a competitor, can sometimes earn you a small discount. So to recap your dossier, you have your personal details. You have the VIN, mileage, and usage information for every vehicle. You have the license numbers and driving histories for every driver in the household. And you have your current policy declarations page in hand. You are now more prepared than 95% of the people shopping for insurance online. You have moved from a position of guessing to a position of precision. You have built the factual foundation upon which every accurate quote will be constructed. You've taken control. Now that you have this arsenal of information ready, the battlefield looks a lot less intimidating. But before you charge ahead and start plugging this data into websites, there's one more critical piece of the puzzle. You need to understand what you're actually buying. What do all those terms on your declarations page, liability, collision, comprehensive, uninsured motorist, actually mean for you, your car, and your financial future? That is the language of insurance, and mastering it is the key to not just getting an accurate quote, but getting the right quote. And that's exactly what we're going to decode next. Think of your car insurance policy not as a single document, but as a custom-built suit of financial armor. Each piece you add has a very specific job, protecting you from a different kind of threat. When you're getting a quote online, you are the armorer. You are choosing the metal, the thickness, and the design. Get it right and you're untouchable. Get it wrong, and you're walking into battle with a shield made of cardboard. The first, most critical, and legally required piece of this armor is liability coverage. This is the only part of your insurance that has absolutely nothing to do with you or your car. It's all about protecting other people from you. If you cause an accident, you are legally responsible or liable for the damage. This coverage is your shield. It steps in to pay for the other person's car repairs and their medical bills, so you don't have to sell your house to do it. When you look at a quote, you'll see liability written as a series of 3 numbers, like 25/50/25 or 100/300/100. This isn't a secret code. It's the blueprint of your shield, measured in thousands of dollars. The first number is the maximum amount your policy will pay for a single person's injuries in an accident you cause. So a 25 means $25,000. The second number is the maximum total your policy will pay for all injuries in a single accident. A 50 means $50,000 total, no matter how many people are hurt. The third number is the maximum it will pay for all property damage. That means the other person's car, their mailbox, that fire hydrant you took out in that one accident. A 25 here means $25,000 for property damage. So let's put this into a real-world scenario. You're driving, you glance down at your phone for a split second, and bam, you rear-end a brand new BMW. The driver has whiplash and their car is seriously damaged. The state minimum liability in many places is around that 25/50/25 mark. The other driver's medical bills come to $30,000. Your policy has a 25 for single-person injuries. It pays the first $25,000. The remaining $5,000? That's on you. The bill comes directly to you. Now for their car. That new BMW? The repair bill is $40,000. Your policy has a 25 for property damage. It pays the first $25,000. The remaining $15,000? Again, that's your problem. Suddenly, a 2-second mistake has you $20,000 in debt, and that's before lawyers get involved. This is why just picking the state minimum to get a cheap quote is one of the most dangerous financial gambles you can possibly make. So, liability is your shield protecting others. But what about your suit of armor? What about your own car? That's where the next 2 pieces come in, collision and comprehensive. They often get bundled together, but they are completely different. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, or even flipping your car over. It doesn't matter who was at fault. If you hit the BMW, collision is what pays to fix your car. If someone with no insurance runs a red light and T-bones you, collision is what pays to fix your car. It is the chest plate of your armor, protecting the core of your investment. Comprehensive coverage is the wild card. Its technical name is other than collision, which is a perfect description. It protects your car from almost everything else except a collision. A tree branch falls on your car during a storm? That's comprehensive. A massive hailstorm leaves it looking like a golf ball? Comprehensive. You're driving down a country road and a deer jumps out in front of you? Believe it or not, that's comprehensive, not collision. It also covers theft, vandalism, fire, and flooding. Think of comprehensive as the helmet and full body protection for all the random, bizarre, and unfortunate things life can throw at your vehicle. Now, for both collision and comprehensive, there's a gatekeeper you have to get past first. It's called the deductible. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company starts paying. You choose this amount. It could be $250, $500, $1,000, even $2,000. Let's say you have a $1,000 deductible, and you get into an accident that causes $8,000 of damage to your car. You pay the first $1,000 to the body shop. Your insurance company then pays the remaining $7,000. This is the most direct lever you can pull to change the price of your quote. A higher deductible means you're taking on more personal risk, so the insurance company gives you a lower premium. A lower deductible means they're on the hook for more, so they charge you a higher premium. There is no right answer here. The key is to choose a deductible you could comfortably pay tomorrow in cash without causing a financial crisis. If you have a $1,000 emergency fund, a $1,000 deductible is a great choice. If you don't, a $250 deductible might be worth the higher monthly cost for the peace of mind. So we've protected others with liability, and we've protected our car with collision and comprehensive. But what if the person who hits you is the one with the cheap state minimum cardboard shield? Or worse, what if they have no insurance at all and just drive off? 1 in 8 drivers in America is uninsured. That's a terrifying statistic. This is where your armor needs a special kind of reinforcement: uninsured and underinsured motorist coverage. This is insurance you buy to protect yourself from the irresponsibility of other drivers. If an uninsured driver hits you and you're injured, your uninsured motorist bodily injury coverage steps in and pays for your medical bills, just like their liability coverage was supposed to. Underinsured motorist coverage is similar. It kicks in when the at-fault driver has insurance, but their low liability limits, that 25/50/25 policy we talked about, aren't enough to cover your serious injuries. Your underinsured coverage pays the difference, up to the limits you select. In some states, these are mandatory. In others, they're optional. But in every state, they are absolutely crucial. Finally, there are 2 last pieces that deal directly with medical expenses: medical payments coverage, often called MedPay, and personal injury protection, or PIP. They might seem similar to your health insurance, but they are faster and more direct for car accidents. They pay for medical expenses for you and your passengers, regardless of who was at fault in the accident. This means you don't have to wait for lawyers to argue for 6 months to figure out who's paying for your ER visit. MedPay is a straightforward amount, say $5,000, that can be used for health insurance deductibles, co-pays, or ambulance rides. PIP is more common in what are called no-fault states and is more robust. It not only covers medical bills but can also cover things like lost wages if you can't work after an accident, or even services you need to hire, like childcare. Liability, collision, comprehensive, deductibles, uninsured motorist, MedPay, PIP. This is the language. This is the armory. Now that you can tell the difference between a shield, a chest plate, and a helmet, you can finally walk onto that online quote battlefield and understand what you're looking at. You're no longer just clicking buttons. You're making informed, powerful decisions. But now comes the million-dollar question. How much armor do you actually need? What are the right numbers? Is 100/300/100 enough? Should you go for 250/500/250? When does it become overkill? Choosing those liability limits is the single most important decision you will make, the one that separates a minor inconvenience from total financial ruin. And figuring out that sweet spot, getting maximum protection without needlessly overpaying, is the secret we are cracking open next. Let's start with the absolute foundation of your financial suit of armor: liability coverage. This isn't for you. It's for everyone else on the road. It's the coverage that stops a bad day from turning into a bad decade. When you see liability limits, they're written as a series of 3 numbers like 25/50/25. This isn't some secret code. It's your shield against financial ruin, and understanding it is critical. The first number is the maximum amount in thousands of dollars your insurance will pay for bodily injury to a single person in an accident you cause. So a 25 means $25,000. The second number is the maximum total your policy will pay for bodily injury for the entire accident, no matter how many people are hurt. So a 50 means $50,000 total. The third number is the maximum it will pay for property damage, that's the other person's car, or maybe a fence, a mailbox, or even a storefront you might hit. A 25 here means $25,000 for all property damage. Now, almost every state has a legal minimum you're required to carry. And for many states, that minimum is shockingly low, something right around that 25/50/25 mark. Let me be crystal clear. Carrying state minimum liability is one of the most dangerous financial gambles you can possibly take. It's like going into a sword fight wearing a t-shirt. Let's play this out. You have a 25/50/25 policy because it's cheap and it's legal. You glance at a text just for a second, and you rear-end a brand new Lexus at a stoplight. That Lexus is carrying a family of 3. The driver gets whiplash and a herniated disc. The passenger in the front breaks their wrist. The child in the back is okay, thank goodness. The Lexus? It's easily a $60,000 car, and the damage is significant. Let's say it's $40,000 to repair it. Your policy's property damage limit is $25,000. The car repair bill is $40,000. You are now personally on the hook for that $15,000 difference. The other driver's insurance company isn't going to just forgive it. They will come after you for it. Your savings, your assets, they're now at risk. But it gets so much worse. Let's look at the medical bills. The driver with the back injury needs surgery and physical therapy. Their bills quickly soar past $70,000. Your per-person bodily injury limit is $25,000. That's it. That's all your insurance will pay. You are now personally responsible for the remaining $45,000. The passenger with the broken wrist has bills totaling $30,000. Again, your policy pays $25,000. You owe the other $5,000. In this very common, very plausible scenario, your legal insurance policy has left you with a bill for $65,000. And that's before they sue you for lost wages, for pain and suffering. That number can easily balloon into the hundreds of thousands of dollars. They can garnish your wages for years. They can put a lien on your house. One moment of distraction, protected by paper-thin coverage, has just derailed your entire financial future. So what's the right number? Most financial experts agree that you should never carry less than 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for all injuries in an accident, and 100,000 for property damage. And frankly, in today's world of $80,000 pickup trucks and complex medical procedures, even that might not be enough. The sweet spot for most middle-class families is $250/500/100. The surprising part? The price difference to jump from the pathetic state minimum to truly robust protection is often shockingly small. We're talking maybe $10 or $20 a month. It is the single best bargain in the entire world of insurance. Now, once we've covered our responsibility to others, it's time to protect our own car. This is where collision and comprehensive coverage come in. They are two different things that people often confuse. Collision is simple. It pays to repair or replace your car if you hit something. Another car, a pole, a guardrail, a tree, if you are in control of the vehicle and it makes an impact, collision coverage is what fixes your car. It doesn't matter who was at fault. If you caused the accident, it pays. If you're the victim of a hit and run, it pays. Comprehensive is for almost everything else. Think of it as the act of God or weird stuff coverage. A tree branch falls on your car during a storm. A deer decides to play chicken with your front bumper. Your car gets stolen. It's vandalized. A massive hailstorm makes it look like a golf ball. A rock flies up from the highway and cracks your windshield. All of that is comprehensive. For both collision and comprehensive, you have to choose a deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. It's your share of the repair cost. Common deductible amounts are $250, $500, $1,000, or even $2,000. And here's the trade-off, the dial you have to tune. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. So which one should you choose? The answer is tied directly to your emergency fund. Here is the golden rule. Your deductible should never be an amount you couldn't write a check for tomorrow without panicking. If you choose a $1,000 deductible to save $12 a month, but you don't actually have $1,000 in savings, you're setting a trap for yourself. When an accident happens, and it will, you won't be able to afford the deductible to even get your car fixed. You'll be stuck. A $500 deductible is a great starting point for most people. It keeps your premium reasonable, and it's an amount that most people can, or should be able to, cover from their savings. Okay, so we've built the core of our policy. We have liability to protect our assets from lawsuits, and we have collision and comprehensive to protect the car itself. Now we bolt on the extra but essential pieces of armor. First up is uninsured and underinsured motorist coverage, or UM/UIM. This is one of the most important and tragically overlooked coverages you can buy. What happens when the person who hits you has no insurance, or they have that worthless state minimum policy we just talked about? Who pays for your medical bills? Who pays for your lost wages when you can't work? You do. Unless you have this coverage. Uninsured motorist coverage steps in and acts as the other driver's insurance when they don't have any. Protects you from the lawbreakers. Underinsured motorist protects you from the people who followed the law, but just barely, carrying a policy that can't even begin to cover the damage they caused you. With an estimated 1 in 8 drivers on the road completely uninsured, skipping this coverage is like playing Russian roulette every time you get on the highway. Next, you'll see options for medical payments, often called MedPay, or in some states, personal injury protection or PIP. This is another crucial layer. It pays for medical expenses for you and your passengers, regardless of who is at fault. Think of it as instant, no questions asked health coverage for a car accident. If you have a high-deductible health plan, MedPay can be a lifesaver, covering that deductible and copays so you don't have to drain your savings just to get care after a crash. Finally, we have the smaller convenience-based coverages. Rental reimbursement pays for a rental car while yours is in the shop after a covered claim. If your car is your lifeline to get to work, this is a must-have. 10 days without a vehicle can be a logistical and financial nightmare. For a few dollars a month, this coverage solves that problem. And then there's roadside assistance, which covers things like towing a flat tire or a dead battery. It's cheap, and it's a lot better than being stranded on the side of a dark highway with no idea who to call. So there it is, the complete blueprint. Liability set at $250/500/100. A reasonable $500 deductible for collision and comprehensive. And all the essential add-ons. Uninsured motorist, MedPay, rental, and roadside. This is the gold standard. This is the policy that lets you sleep at night. We have now designed the perfect financial shield. We know exactly what coverages we need to be truly protected. We figured out the sweet spot. But now comes the moment of truth. Because all of these choices are just one half of the equation. The other half is you. We've built the perfect suit of armor, but we haven't told the insurance company who it's for. And that, as you're about to see when we actually fill out the quote form, changes the price of everything. Let's start filling in the blanks. And the first blank is usually the easiest, your name. But even here there's a trap. Use your full, legal name as it appears on your driver's license. Not your nickname, not a shortened version. If a claim happens, the name on your policy needs to match the name on your license and registration. A mismatch is a red flag, an unnecessary complication you don't need when you're already stressed. Same goes for your date of birth. Get it right. This is step 1 in the insurance company's process of verifying you are who you say you are. Next, your address. This seems simple, but it's one of the most powerful factors in your final price. You're not just telling them where to mail the bill. You're telling them where your car lives. It's called the garaging address, and it feeds a mountain of data into their pricing algorithm. They know the weather patterns in your zip code. Are you prone to hail, flooding, or hurricanes? They know the crime statistics. What's the rate of auto theft and vandalism in your neighborhood? They know the traffic density and accident frequency on your local roads. Moving just a few miles can swing your premium by hundreds, even thousands of dollars a year, because you've moved into a different risk pool. This is also why you must be honest. Using your parents' address in a quiet suburb when you live and park your car in a dense city center is insurance fraud, plain and simple. If they find out, they can deny your claim and cancel your policy, leaving you to pay for a totaled car and potential lawsuits all by yourself. Now we get to the other people. The quote form will ask about all licensed drivers in your household. This is a huge point of confusion and friction. People think, well, my spouse has their own car and their own insurance, or my 20-year-old son is away at college most of the year. It doesn't matter. From the insurer's perspective, Anyone with a license living under your roof has potential access to your car keys. They represent a potential risk. You have to list them. Hiding a high-risk driver, like a teenager with a recent accident, is another form of fraud. The system will find them eventually. Insurance companies use a massive shared database called the Comprehensive Loss Underwriting Exchange, or CLUE. It's like a credit report for your insurance history. When you apply, they run your name and address through it, and it often pulls up everyone else who has lived at that address and their claim history. If you forget to list your roommate with 2 DUIs, their system will likely flag it anyway, and your quote will be invalid. So what do you do if you have a high-risk driver in your household you genuinely don't want on your policy because they have their own insurance, or you forbid them from driving your car? You can't just leave them off. The correct way to handle this is to list them, and then specifically ask for them to be an excluded driver. This is a formal endorsement on your policy that says this specific person is not covered to drive your vehicle under any circumstances. If you exclude your son, and he takes your car for a joyride and crashes it, you have zero coverage. It's a serious step, but it's the honest and correct way to prevent their driving record from wrecking your insurance rates. Next up, the personal details that feel, well, a little too personal. Marital status. Why do they care if you're married? Statistically, married drivers file fewer claims than single drivers. Actuaries, the mathematicians who calculate risk, see marriage as a signifier of a more stable, risk-averse lifestyle. You're more likely to be home at night than out at a bar. You might have kids in the car, making you a more cautious driver. It's not a judgment on your character. It's a cold, hard statistical correlation, and it can save you a significant amount of money. Same goes for homeownership. Are you a homeowner or a renter? Again, the data shows that people who own their homes tend to be more financially stable and file fewer auto claims. It's another piece of the puzzle they're building about you. It also opens the door to a huge discount we'll talk about later, the multi-policy or bundling discount, where you insure both your home and auto with the same company. Then comes your occupation and education level. This is where people really start to get suspicious. What on earth does my job have to do with my driving? Again, it's all about statistics. The algorithm isn't judging your career choice. It's sorting you into a risk group based on data from millions of other drivers. For example, engineers and scientists often get better rates. The stereotype, backed by data, is that they are meticulous, detail-oriented, and analytical, traits that translate to safer driving. On the other end, jobs that involve a lot of driving, like delivery drivers or outside sales reps, might see higher rates because their sheer time on the road increases their risk of an accident. When you get to the drop-down menu for your job, take a moment to look through the options. If you're a software project manager, you might find categories for manager, engineer, computer professional, or project manager. One of those categories is likely rated more favorably than the others. You can't lie, but if your title fits multiple descriptions, you can choose the one that best represents your role in the most favorable light. The same logic applies to your level of education. A PhD statistically correlates with a lower risk profile than a high school diploma, and the rates will reflect that. Feels unfair, but it's how the math works. And now we arrive at the single most controversial, most misunderstood, and most impactful personal factor of them all: your credit score. Yes, in most states, the company that insures your car cares deeply about your financial history. Before you get angry, let's break this down because it's not what you think. They are not pulling your FICO score that a mortgage lender sees. Instead, they use the information from your credit report to generate something called a credit-based insurance score. Why? Because decades of industry data have shown a powerful, undeniable correlation between this score and the likelihood that a person will file a claim. People with lower insurance scores statistically file more claims and more expensive claims than people with higher scores. The theory is that how you manage your financial responsibilities is a strong predictor of how you manage other responsibilities in your life, including driving a 2-ton metal box at 70 miles per hour. This is a huge deal. The difference between an excellent insurance score and a poor one can change your premium by more than 100%. It can be a bigger factor than your driving record. You could have a perfectly clean record, no accidents, no tickets, but a low insurance score could still label you as high risk and double your price. Now for 2 critical reassuring facts. First, when an insurance company pulls this data, it is a soft pull. It does not affect your credit score in any way. Unlike applying for a new credit card or loan, you can get 100 insurance quotes and it will have zero impact on your credit rating. So don't be afraid to shop around. Second, this practice is not legal everywhere. Because of concerns that it unfairly penalizes lower-income individuals, some states have banned or severely restricted the use of credit in setting auto insurance rates. As of now, California, Hawaii, and Massachusetts are the main states that forbid it. Michigan has also passed laws to limit its influence, so if you live in one of those states, you can breathe a little easier on this point. For the rest of us, it's a reality of the modern insurance market. They've looked at your car, the armor. They've looked at the coverages, the strength of that armor. And now, by looking at your address, your job, your household, and your financial habits, they have built a detailed profile of the person inside the armor. They've calculated your risk. They have a number. They've decided what it will cost to protect you. But we're not done, because that number they've calculated is just the starting point. It's the sticker price. And just like with a car, you never pay the sticker price. So how do you get the real price? The price after the negotiation? You do it with discounts. Discounts are the single most powerful tool. You have to slash your auto insurance premium. Insurers have dozens of them, but they don't always advertise them, and they certainly don't always apply them automatically. You have to know what to ask for. You have to know which boxes to check. This is where you take back control. Let's break down the hidden money you're probably leaving on the table. We'll start with the discounts related to you, the driver. The most common and one of the biggest is the good driver or safe driver discount. This sounds simple, right? Don't get in accidents, don't get tickets. But it's more nuanced than that. Most companies look at your record for the past 3 to 5 years. One speeding ticket in that window can erase this discount entirely, costing you hundreds of dollars not just once, but every year until it falls off your record. Think about that. A single $150 ticket can end up costing you $600 or $700 in lost insurance discounts over 3 years. This is why fighting a ticket, or taking a defensive driving course to have it removed from your record, can have a massive return on investment. If you have a clean record, make sure this discount is applied. It can be worth anywhere from 10 to 30%. Don't just assume they've given it to you. Verify it. Next up, for families with younger drivers, is the good student discount. This one is huge. Adding a teenager to your policy can feel like a financial gut punch. It can literally double your premium overnight. But if that student maintains a B average or better, is enrolled full-time in high school or college, and is under a certain age, usually 25, you can get a significant discount. We're talking 15 to 25%. You'll need to provide proof like a recent report card or transcript, but the effort is absolutely worth it. It can be the difference between a teen's insurance being painful and it being completely unaffordable. Then there's the proactive discount, the defensive driving course. Many states and insurance companies offer a rate reduction for completing an approved driver safety course. These courses are often online, take a few hours to complete, and cost a small fee, maybe $20 to $40. In return, you can get a 5 to 10% discount on your insurance for 3 years. You do the math. On a $2,000 annual premium, a 10% discount is $200. You spend $40 once to save $600 over 3 years. That's an unbelievable return. It's a no-brainer for almost anyone, especially for drivers with a less-than-perfect record or for older drivers looking to secure a mature driver discount. Now let's talk about your car. Your vehicle itself is a treasure trove of potential discounts. The most important ones are tied to safety and security. Does your car have anti-lock brakes? Airbags? Daytime running lights? Almost every car made in the last decade has these, but you need to make sure your insurer knows it. The real hidden gem here is the anti-theft device discount. If your car has a passive alarm system, one that arms automatically when you lock the doors, or a vehicle recovery system like LoJack, that's a discount. Many people miss this. They don't know what system their car has, so they leave the box unchecked. Don't do that. A quick search of your car's make and model, or a look at the original window sticker if you have it, can tell you exactly what security features you have. Checking that one extra box could save you 5 to 20%. Insurers love anti-theft devices because it means they're less likely to have to pay out a total loss for a stolen vehicle. Next, let's move on to the policy itself. This is where the biggest savings are often found, and it starts with one magic word: bundling. Insurers want as much of your business as possible. They will give you their steepest discounts if you give them more than one policy. This is the multi-policy discount. Bundling your auto insurance with your home insurance or renter's insurance is almost always a massive money saver. The discount can be up to 25% on both policies. This is so important that even if you're only shopping for car insurance, you should always get a quote for your renter's or homeowner's insurance from the same company. Why? Because Company A might have a slightly cheaper car insurance rate, but Company B, when you bundle, might give you such a huge discount on both policies that your total cost, car plus home, is significantly lower. Remember, you're not trying to find the cheapest car insurance. You're trying to find the lowest total insurance cost for your life. And for 9 out of 10 people, bundling is the key. The next policy power play is the paid-in-full discount. Most people pay their insurance bill monthly. Feels more manageable. But insurance companies add a small service fee to each of those monthly payments. It's for the administrative cost of processing 12 payments instead of 1 or 2. If you can afford to pay your entire 6-month or 1-year premium upfront, you can often get a discount of 5 to 10%. On a $1,800 annual premium, a 10% discount is $180. That's $180 back in your pocket just for paying differently. You're going to pay the money anyway, why not pay less? If a full year is too much, ask about a 6-month plan. It often has a discount too. While you're at it, sign up for automatic payments and paperless billing. These are small, easy discounts, maybe $5 or $10 each billing cycle, but why leave free money on the table? It all adds up. Finally, let's cover the discounts that most people have never even heard of. These are the ones that separate the casual shopper from the true savings expert. First is the affinity or group discount. Insurance companies make deals with large organizations, companies, universities, professional groups, even credit unions, to offer special rates to their members. Are you a teacher? An engineer? A nurse? A member of the military? There are discounts for that. Did you graduate from a specific university? Check your alumni association. Do you work for a large corporation? Ask your HR department. Are you a member of AAA, AARP? Or a warehouse club like Costco? All of these affiliations can unlock a special rate that isn't available to the general public. You need to think about every group you belong to and ask the insurance company if they have a partnership. This is one of the most underutilized discounts in the entire industry. And now for the new frontier of discounts. Usage-based insurance or telematics. This is where you agree to let the insurance company monitor your driving habits, usually through a small device you plug into your car or a smartphone app. I know what you're thinking, privacy, and that's a valid concern. But let's talk about what it actually does. It tracks how you drive, not necessarily where you drive. It measures things like heart braking, rapid acceleration, the time of day you typically drive, and your total mileage. If you are a genuinely safe driver who doesn't speed, doesn't slam on the brakes, and doesn't drive a lot late at night, this can be the single biggest discount you can get. You are providing the insurance company with concrete proof that you are a low risk. Instead of being priced based on the averages of people in your zip code with your kind of car, you're being priced based on you. The initial discount for just signing up can be 10%, and after a monitoring period, your total discount could reach 30 or even 40%. For safe, low-mileage drivers, telematics is the ultimate way to shatter that sticker price and get a premium that truly reflects your personal risk. You've gathered your information, you understand your coverage, and now you have an arsenal of over a dozen discounts to claim. You have the keys to unlock hundreds, maybe even thousands of dollars in savings. But knowing about the discounts is only half the battle. How do you actually use them to make companies compete for your business? How do you take all this knowledge and turn it into the lowest possible number on a quote page? That is the final critical step. It's where we put everything into action and make the system work for us, not against us. And the way we do that is by orchestrating a head-to-head competition for our money, using two powerful, distinct strategies. Think of it like this. First, we cast a very wide net to see what's out there. Then we use a spear to target the biggest fish. This two-pronged attack is the secret to maximizing your savings and ensuring you're not leaving a single dollar on the table. Let's start with casting the net. This is where we leverage the power of insurance comparison websites, also known as quote aggregators. You've seen the commercials. These are the platforms where you enter your information once, and they blast it out to dozens of their partner insurance companies, returning a list of quotes in minutes. It sounds perfect, right? It's an incredibly powerful tool, but you have to use it correctly and understand its limitations. The primary advantage is speed and efficiency. In 10 to 15 minutes, you can get a baseline understanding of what the market looks like for someone with your profile. You'll see names of companies you've never even heard of alongside some familiar ones. This is how you uncover hidden gems, smaller, regional carriers that might offer fantastic rates, but but don't have the billion-dollar advertising budgets of the giants. This is the wide net in action, pulling in possibilities from all corners of the market. But here's the crucial part you need to understand. First, not all insurance companies participate in these sites. Some of the absolute biggest players in the industry, like Geico and Progressive, often prefer you to come to them directly. They don't want to be listed side by side in a price war they can't completely control. So, if you only use an aggregator, you are missing a massive slice of the market. Second, and this is a big one, you need to be prepared for the aftermath. When you enter your information on some of these sites, you're not just getting quotes. You're becoming a lead. Your phone number and email are being passed along to agents and companies who are now authorized to contact you. This can lead to a flood of calls and emails. So here's the pro tip. Before you start this process, create a separate temporary email address, a burner email if you will, specifically for this task. And if you're comfortable, consider using a Google Voice number instead of your personal cell. This simple step keeps your personal inboxes clean and puts you in control of the communication. So, the first step in our action plan is to choose 2, maybe 3 reputable comparison websites. Don't just use one. Different aggregators have partnerships with different carriers, so using a couple of them widens your net even further. Fill out the information on each site. And this is critical. Use the exact same information on every single one. The same mileage, the same coverage levels, the same drivers, the same VINs. Consistency is the key to an apples-to-apples comparison. Once the results roll in, your job is to analyze them. Ignore the flashy ads that say, your rate is $35 a month, until you click and see the real number. Look at the top 5 to 7 cheapest options from your combined searches. Write them down. This is your short list. But we are not done. The quote you see on an aggregator is an estimate. It's close, but it's not a guarantee. Now we move to the second part of our strategy, the precision strike. You're going to take the top 3 or 4 companies from your aggregator shortlist and go directly to their websites. One by one, you'll re-enter all your information again, directly into their system. Yes, it's a bit repetitive, but this is the verification step. This is where you confirm the rate is real and not just a teaser from the comparison site. Often the rate will be identical, but sometimes it might fluctuate slightly up or down. This direct from the source quote is the one you can actually count on. After you've verified the best rates from your wide net search, it's time to hunt the big fish that weren't in the net to begin with. You need to go directly to the websites of the major carriers who often skip the comparison sites. I'm talking about companies like Geico, Progressive, and State Farm. You have to go to them. You owe it to yourself to see what they can offer, because for many people, one of these giants will end up being the cheapest option. You just won't know unless you check. So, you now have a handful of verified, hard quotes. You have the best from the aggregators, and you have the best from the direct-to-consumer giants. For many people, the process could end here. You could compare the final numbers, look at the coverage details, and confidently pick a winner. You've already done more than 95% of the population, and you are guaranteed to have found a great deal. But there is one more level to this game. One final precision strike that can sometimes yield incredible results, especially if your driving situation is a little more complex. You're going to pick up the phone. You're going to call a local independent insurance agent. Not an agent that only works for one company, like State Farm or Allstate. An independent agent works with multiple insurance companies. They are essentially a human version of a quote aggregator. The difference is they know the nuances. They know which carrier is more forgiving of a speeding ticket, or which one offers the best discount for a specific profession in your state. Here's how you play this final card. You call them up and you are completely transparent. You say, "Hi, I've done my online research. My best quote for this exact coverage is X dollars per month with company Y. I'm wondering if you can use your network to beat that price." This is a power move. You've armed yourself with data. You're not just a random person asking for a quote. You are an informed consumer with a specific target to beat. This transforms the conversation. A good independent agent will see this as a challenge. They'll know you're serious and won't waste their time with highball offers. They will go to bat for you, searching through their portfolio of carriers looking for a win. Sometimes they can't beat it, but sometimes they can. And sometimes they can beat it by a lot, or get you significantly better coverage for the same price. This one phone call could be the most profitable 10 minutes of your year. So let's recap the entire quote gauntlet battle plan. Step 1: Preparation. Gather all your documents. Driver's licenses, vehicle VINs, and your current insurance declaration page. Create a temporary email address. Step 2. Cast the wide net. Go to 2 different insurance comparison websites. Fill out your information identically on both and get a broad view of the market. Identify the top contenders. Step 3. Verify. Take the top 3 or 4 companies from your net and go directly to their websites to get a firm, verified quote. Step 4. Hunt the giants. Go directly to the major carriers who don't typically play on comparison sites and get quotes from them as well. Step 5. The human element. With your absolute best quote in hand, call a local independent agent and challenge them to beat it. By the end of this process, which should take about 90 minutes, you will have a crystal clear picture of the absolute best rate you can possibly get. You will have forced the market to compete for your business in the most efficient way possible. But before you make that final click, there's one last piece of advice. The cheapest price is not always the best choice. Insurance is not just a number. It's a promise. It's a promise that if something terrible happens, that company will be there to make you whole. Spend 5 minutes doing a final check on your top 2 choices. Google their names plus the term claim satisfaction reviews, or J.D. Power rating. See what real customers say about their experience when they actually had to use the insurance. A company that is $10 cheaper per month isn't a bargain if they make the claims process a nightmare. You want a balance of a great price and a solid reputation for customer service. You are now armed with more knowledge than almost anyone shopping for car insurance. You know how the system works, what the numbers mean, and exactly how to execute a strategy that puts you in complete control. This isn't just about saving $50. This is about saving hundreds, maybe even thousands of dollars over the life of your policy. It's about taking that money and using it for a vacation, for your savings, for your family, for anything other than overpaying for a service you are legally required to have. You have the roadmap. Now go get the rate you deserve.